market has had an amazing rally in the past week. Is it the start of a big bull run, or will Europe's sovereign debt issues crush sentiment once again? Joining me today at the Fidelity Investment Forum is Paul Taylor. Paul, the All Ords has had its best winning streak since April. What is your outlook for the market over coming months?
Yeah, in terms of the next few months, I think it's very difficult to work out. I think markets in the short term, there's fads and fashions. Over a 3-month, 6-month, 9-month, or even a 12-month basis, I think you get fads and fashions. So fundamentals don't always out over a short-term basis. We think you need to invest at least on a 3-year basis. We think fundamentals will out over a 3-year basis. So we're always looking at least that sort of time frame. I think the way we look at the market at the moment is that you are, getting really good, great quality stocks at great prices. So plenty of long-term investment opportunities, great long-term investment opportunities as we are here today.
How are valuations looking across the market?
Yeah, market valuations I think are actually quite attractive. So the current PE on the Australian market is about 10 times. So long-term average is closer to 15 times. Dividend yield on the Australian market about 5.9%. So that's really attractive. That's a great. Even if the market does nothing, you're picking up pretty much a 6% after-tax return. So we think they're really attractive levels. Over the long term, even if you try to, one of the other measures we look at is what's called the Graham-Dodd PE ratio. So that looks at a through-the-cycle type valuation. And even at that level, the Australian market's looking really attractive. So that means good long-term investment opportunities.
One of the key themes in your presentation today was the importance of dividends. Why are dividends important, and what yields are you seeing across the market?
Yeah, we think dividends are actually very important. Studies show that over the long term, basically equity investors get paid in the dividends they receive and the growth in those dividends, which makes sense because that's the economic rent as an equity investor that you derive from that investment. So dividends are basically how equity investors get paid. And right at the moment, as an equity investor, we're getting paid very well. So the dividend yield on the Australian market is almost 6%, 5.9%, and that's not totally, but it's close to a fully franked yield as well. So it's close to an after-tax return of 6%, which is a very attractive level. And even if you look deeper in the market, you can get much better dividend yields than 6%.
How sustainable are the yields given recent downgrades to global growth forecasts?
Yeah, I think that is one of the key questions. And we actually think dividend yields are sustainable. So to answer that question, I think you need to look at two factors. One is the balance sheet of Australian corporates, and the second one is the cash flows, the free cash flows of Australian corporates. And on the balance sheet argument, actually Australian corporate balance sheets are in fantastic shape. So one of the measures we look at is the gearing ratio, so basically how much debt do they have. Gearing ratio is as defined as net debt over net debt plus equity. Long term has been averaging in Australia about 32%. Right at the moment we're closer to 20%. So Australian corporates have very strong balance sheets. They don't have a lot of debt. They're in a really good position. Their balance sheets got repaired as we went through the GFC as they raised equity. So balance sheet's really strong. The second question is free cash flow. And once again, as we stand here today, free cash flow, even after dividends, is pretty much at highs. So we've got the cash flow to pay out the dividends, and we've got really strong balance sheet from the corporate. So we think dividends are very sustainable.
You've listed Rio Tinto and Wesfarmers as two of your top holdings. What do you like about those companies in particular?
Yeah, well, I think first of all, both are really good quality companies. They've got strong balance sheets. They've got strong management teams. But if I dig into each individual one, Rio Tinto, for example, very attractively valued, quite strong growth prospects. Is probably the standout in the resources sector because of its valuation. But you're picking up a quality operator. Rio Tinto own the tier 1 assets. They own the low-cost, long-life mines, and that's what you want to own through the cycle. So very attractively valued, great operator. Wesfarmers, similarly, great management team, strong balance sheet, good operators, and a great business. They have one of the interesting things about Wesfarmers is because obviously retail has been having a pretty tough time. Wesfarmers has got a little bit more of their growth in their own hands. So Wesfarmers, through owning Coles, that business is actually turning around, and that they're doing very well. All the signposts show that Coles is actually doing very well and returning to a much better position. Coles has always been a great asset, maybe it just hasn't been quite managed as it should be. And, they've got a great footprint, a great asset, a great brand, and under the Wesfarmers ownership, they're getting much better returns. So we're seeing the return on equity, return on invested capital significantly improve in Coles, and we're actually going to see much better growth in Coles going forward because of actually what Wesfarmers are doing. They're less reliant on market conditions. So, good growth, good company, good dividend yield, 5% dividend yield on Wesfarmers, and a very good turnaround story in Coles.
Paul, thank you very much for joining me today.
You're welcome. Good to see you.